This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report, my independent investment newsletter. Every week I go through a ton of reading and research, charts, and I select a handful of these things every week to highlight in my free email newsletter that goes out Saturday mornings. If you're interested in receiving something like this, just go to thefelderreport.com. Right there on the homepage, you can sign up and you'll be good to go. My guest for this episode is Diego Parrilla, and I've been trying to get Diego on the podcast for quite some time now because I've just been absolutely enthralled with his thinking. He has been eerily prescient in calling some major turning points in a variety of markets over the past several years. Back in 2014, he published The Energy World is Flat, in which he detailed the coming crash in the price of crude oil, along with the dynamics that he outlined that would ensure such an outcome. Oil prices crashed 70% after that over the next year and a half, 2 years. In August 2017, he published a new book called The Anti-Bubbles, in which he laid out the case for rise in volatility across a number of markets. And just a few months later, the short volatility ETF complex blew up in spectacular fashion. Essentially overnight, these ETFs went to essentially zero in a record run higher in the VIX Index. So in this interview, what I wanted to do was really delve into Diego's unique background, how it helps him to see things differently than most people on Wall Street. Diego also shares some of what constitutes his research process and the inspiration behind these investment theses. Finally, he shares his thoughts on the current state of the global markets and why he believes gold is set to shine in the near future. So please enjoy my conversation with Diego Parrilla.
Ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Diego, welcome to the show. I'm really excited to finally get this done. You're kind enough to give me a second chance after I had some technological issues the first time we tried to do this a few months ago. But actually, the markets have done some things in the meantime that make this conversation perhaps even more interesting than the back in May when we tried to do this the first time. But welcome to the show. I'm really glad to have you here.
Oh, thank you so much. And I think the problems were partially on my end too. So anyway, glad that we can make it again.
Well, it's pretty amazing that I'm here in Oregon and you're in Spain and we can do this. So, I want to just start with you have one of the things that's most interesting to me is the unique perspective that people bring to the markets. And you have a degree in mining. What was it that first, I guess, drew you in that direction?
Well, my father, really. I come from a tradition of mining and petroleum engineers. I completed my bachelor's and master's in Madrid. And I was lucky enough to get the opportunity and a scholarship to pursue a master's in mineral economics at the French Institute of Petroleum in Paris. And it was a joint degree with the Colorado School of Mines in petroleum economics and management. That interest in economics and engineering, it was also very early, also from my father, and I think in my case, that master really opened a lot of opportunities. It was a time I developed my thesis in something called real options. It was the mid-late 90s. The collapse in commodities and a number of crises, and that work caught the eye of J.P. Morgan. They offered me a role in trading, and to be honest, at that point in time, I had no idea what the whole finance world looked like from a markets perspective. I was very much earmarked to go into the engineering and more financing of projects than the actual markets. But I found financial engineering fascinating, and this is where I've spent, really most of my career, throughout the commodity side, but also very closely linked to macro and foreign exchange and others.
And, what do you feel, because there's a lot of groupthink in the world of finance, probably in, a lot of different, industries. But what do you feel that, your expertise, how do you feel that brings kind of a unique perspective to the world of finance?
Well, I think in terms of the engineering and some of my background coming from that world, it's not unique in the sense there's many others. But I feel that perhaps my uniqueness is a little bit more in, I think quite differently. I think, many people in finance perhaps think more in numbers and ratios and things. I think more in forces. I think more a little bit in terms of equilibriums, disequilibriums. And in that sense, I do actually draw a lot of my views and very contrarian views in this kind of dynamic. So I do, I think sometimes people get dragged down into the very near picture, into the very short term, into the next tick. My views are pretty much the opposite. They build on very, very big picture things, that make sense, that models that, are mechanical in that sense. And I find that some of these relationships, these forces, are very much and appreciated by the markets and by many of their players. And in that sense, I've done this before. I mean, I have a track record of, I guess, being identifying big trends, big changes of trends, such as the energy markets, and this is done, through, building a, thesis and understanding, as you say, a number of angles, whether it's the technical side of the engineering, but also understanding very well the dynamics of the markets and the different regimes in which we operate. So I've seen myself, I guess, going into, the area of bubbles and developing the concept of anti-bubble and trying to find ways in which, dealing with being early, dealing with, you might be right, or there's a massive opportunity, but also managing that huge risk, which is being early, which, it's potentially as, if not more painful than others, than being wrong. Because, so in that sense, everything comes together in this way, and I think it is very powerful to have a different perspective. But you get there are many ways to look at the market, and I think you have to understand, no matter how fundamental you are, or you need to understand technicals and positioning and others. So I think there's a lot of variables that come into what we are. But certainly, I feel that I'm definitely a contrarian thinker, and the ideas that we're about to discuss and the books and others, I think will speak for themselves.
Yeah, and when I think of your work, I think of, Charlie Munger has said it really helps you to have a variety of mental models, from other disciplines that you can apply to the markets or whatnot. And when I think of your work, I think of your engineering and natural resources and mining. These things have the mental models that are involved with understanding those things. Must have terrific application to investing in the markets. And you mentioned the energy sector. And you were just talking about being early, but I was looking back at your call for the oil crash, which was, you weren't just talking about a drop in the oil price, you talked about a real crash. That's exactly what we got, and it looked like your timing was impeccable for that. What was the process that you went through then that helped you see what nobody else was really seeing at that time?
Well, I guess this is I found that writing. It's a very powerful process. You think you know it until you try to put it in writing, whether it's a business plan or a letter to Santa or whatever it is. Writing is a very powerful process. But for me, it's always been a very natural evolution. You develop certain views. You discuss with very smart people around the world with different perspectives. I've been very lucky to be working and having the opportunity to discuss these ideas. And what you realize is that, some of these dynamics, it's almost like you start to develop this thesis. And the beauty is that, some of these ideas might sound almost science fiction at the time, but this process of sparring and throwing very clever arguments and pros and cons and whatever to the thesis, actually it either kills it or reinforces it. And in the case of and you talked about connecting the dots and disciplines. I mean, I read a book called The World is Flat in, I guess it was 2002, shortly after the bust. Many of you will remember the original book from Friedman. And that book, to me, it was an eye opener. Many of us had a sort of a bitter feeling after the bubble, and this book to me opened this completely different perspective to what had just happened. It was really talking about a technological game changer, and how that bubble, which we often associated with negatives, actually created a massive investment in infrastructure, which effectively led to overcapacity, and eventually we have a collapse in prices. But rather than this sour feeling or bitter feeling that many had, it was actually a very positive story. It was a story of a breakthrough technology with huge investment, which after the investments being written off, was actually available in huge size, almost for free. And a lot of the great things that have happened since, would have not been since the 2001 bust, like having the oceans wired with broadband. That was really amazing, and that connected the world. It opened China and India in ways that they were not connected before, and it did amazing things. So that book stayed in my mind, and that perspective stayed in my mind. And many years later, when Fukushima happened, something kind of clicked. I mean, we have had we were in the process of seeing a major technological breakthrough with shale gas and shale oil. That was, the new kid in town. Lots of still today, there's still lots of questions around the viability in the long term. But it's always the case with new technologies. But we had the development of shale gas, what in my view was a complete game changer with Fukushima, which basically brought, as you may remember, is the massive quake that we had in Japan that created this nuclear disaster. But as a result of that, we had basically the natural gas. The natural gas is a market that is historically been very regional. Because of natural gas being a gas, it's difficult to store, it's difficult to transport. So if you either had these gas pipes or it was difficult. So you could have these very big differences in prices, which are across different regions. And what the LNG, the liquefied natural gas market, was doing, it was connecting, gas long term. But these were very much, mega investments that have, a buyer, a seller. There was no spare capacity. But what Fukushima did in a way by taking out all the nuclear or out of Japan for a long period of time, it created this huge demand for energy in the form of natural gas and coal and others. And that basically sent nat gas prices through the roof in the LNG market. Effectively, it's acting as a magnet to be able to continue operating without nuclear. And that brought this parallelism, that flashback almost of the book, and how we had this amazing technology, which was effectively making natural gas hugely abundant and cheap and clean and available with nat gas prices in the US trading at $2 a MMBTU at the time. That's $12 a barrel equivalent. And how at exactly the same time we had Coca-Cola or nat gas, the same asset trading 10 times over at $20 a MMBTU, and or $120 a barrel equivalent. Yet it was very obvious to me that big spike and the fact that this would last for a long time would basically result in a major supply response in LNG, which had great parallelisms parallels with the .com, and we knew that it would take at least 3 years for some of this price response to result into real supply, but we knew it would come. And in that sense, that thesis started a little bit from the fact that nat gas, which had historically been just on its own, and crude oil had no competition, how we would see this game changer process on the natural gas side, and how we had already seen Warren Buffett shifting from diesel into natural gas trains and many others. So I felt that this flattening, went back to Friedman's book, and I wanted to in honor of the book, I kept the title, The Energy World is Flat, but also the structure of the book with the concept of flatteners, of forces that were basically reshaping the world. And in this case, it was kind of the globalization of energy. And one of them was this process of shale, the LNG super cycle, and how crude oil would have to compete for demand, which is something we hadn't seen before in history, therefore nobody would expect. And this process, that view, which had obviously huge implications, suddenly you start throwing many things at the thesis. And the beauty of the process is that, there were very clear winners, there were very clear losers. But as I digged into that, and you understood, that many of these beliefs, the belief that OPEC was infallible, that they were in full control, many of these beliefs were driven by misconceptions. People thought, okay, OPEC is is infallible and is omnipotent. They're so powerful because they control the supply, and because they control the supply, they control the price, and that's not true. And one of amongst many of the very non-consensus views or statements that I made, was that OPEC's success wasn't really a supply side story. That was a necessary but not sufficient condition. The real reason why OPEC had been so successful is it wasn't an oligopoly of supply. It was a monopoly of demand. It was the fact that transportation fuels for the longest time had zero competition. It was all gasoline and diesel and fuel oil. It was all oil derivatives. So the fact that we had a new player, a new kid in town in the form of nat gas, that we had it in huge size and environmentally friendly and very affordable, at the end of the day, alongside the technological developments, pushed my view that the last barrel of oil won't be worth millions; it'll be worth zero. And that sentence, which today sounds pretty obvious to most people, it was really shocking people who we had at that point in time peak oil theory and other misconceptions. So all these things go together. I guess you start with the thesis and that call. The timing was impossible to predict. I mean, I took probably about 9 to 12 months, to write the book and research and everything. And those ideas have been developing for a while, all the way from 2011 plus. So by the time you publish the book, and my thesis was my level of conviction was much higher than before I started writing the book. We threw, okay, how do renewables play into this? You realized, a country like Saudi Arabia invested 120 billion in solar, which effectively was a flattener because it freed up a huge amount of oil that was being used for power generation, which doesn't make any sense when you're in the middle of the desert and you have arguably even more sun than oil. So in that sense, all these things that gave me a very high conviction. Timing was obviously difficult or impossible to predict, but you knew it was a matter of when, not if. And I think the parallels, in that book, I had the two main parallels that I use. One is historical parallels. That's lessons learned from the same market, just different points in time. And we can learn a lot about all the markets But in this case, we could learn a lot about OPEC's failures in the 70s and miscalculations. So we could see that we know that they were not infallible and omnipotent. Quite the contrary. Once things turn around, they could turn around and go the other extreme. But also, as you pointed earlier, the lessons learned and the interconnections with other industries. And this is something that I've continued to do and where I have a lot of interest. And in my first book, I draw the parallels between the dot-com bubble and what I was foreseeing as the energy bubble. And through that process, I actually coined concepts like the energy broadband. It was very difficult for the average person to understand all these technical issues in energy. So I was using the lessons learned during the dot-com, and I was making a one-for-one comparison between, natural gas is internet broadband. The telecoms are the oil majors. And you could see, it was a very powerful process, because when you actually test your thesis against those historical events and other industries, it's amazing. But you actually start to ask yourself questions like, so who is Yahoo? Who is going to be Google? And people ask you exactly the right question on things that haven't happened in a very powerful way. So I find this process fascinating, very powerful, and it's what something that I've kept, and that actually led to the contrarian ideas of my second book and the contrarian concepts that I developed, which are as we've said, starting to play out, and I think are also very powerful.
I want to get to the second book because there's some fantastic stuff to talk about there. But I'm really curious. I mean, it's clear that you have a deep understanding of these markets, but you also pair that with, you pay close attention to the macro trends and developments. I guess my question is, what do you use? What are your sources? What types of techniques do you use? What do you read on a daily basis? I guess digging just more granular into the process. Is it more like books and long-term stuff? Do you read periodicals? Is it a combination of both? Do you use technical analysis? I mean, what are some of the actual, tactics and techniques?
Well, the process has been evolving. I would say that my initial training as a derivatives trader and macro with FX and commodities is really been about probabilities and understanding, trying to translate what the forward curves are telling you, what the volatility, what there's the surface, the term structure, the correlations. There's really a lot of stuff that the markets will tell you if you look into it and you try to explain the dynamics and this becomes more obvious when you have regime changes, which in the world of commodities, where we flip from backwardation to contango with super contango, super backwardations, extremes, all these different forces, is something that you get trained to see in a way that perhaps you wouldn't in other markets. So I would say that I pay very, very close attention to that by training. So I'll be able to develop views across volatility and carries and relative value, and that takes you to cross asset. You start to then look at what conflicting messages do let's say oil versus oil companies, or gold versus miners, or different precious metals, or different currencies. And it's fascinating to see that sometimes, the bond and the equity of the same asset will tell you a different story, whether it's on the surface or whether it's looking into the risk premium embedded into the volatility or different things. So if you can actually translate and understand these dynamics, you start to see already a huge amount of information. So I would say that I start with the with the actual derivatives world, which goes hand in hand with the fundamentals, but it also goes very, very closely with positioning and flows. And I think this is something that you learn as you trade. You understand. You start to see not only the 2 + 2 = 4, as fundamentals will tell you, but also understand that the market can believe that 2 + 2 = 6, and then 8, and then 25. So leaving with positioning, understanding momentum, understanding why smart people think 2 + 2 = 25, and trying to survive that and take advantage of that is huge. So in that sense, you can't ignore technicals and positioning. So my model is basically multi-factor. I look at obviously the macro top-down, number of micro bottom-up issues, cross-asset issues, in terms of what the derivatives are telling you in terms of probabilities and correlations and distributions, and combine that also. And in that sense, I guess the way I've been, my brain is wired. And this is the other big thing about, how do you develop? What do you look for? What do you read? How do you express your views? I would say that, I like to read about many things about many different markets. And I try to learn, as much as I can from other areas. But I think these models that we develop in our minds, as I said, get evolve over time. And I think one of the things that I found is, the other big dimension of the game for me is the emotional side. And I think, you can't ignore that. You need to find ways in which, Warren Buffett might sleep very, very well at night with certain type of risk, but probably wouldn't be able to sleep with different type in a fraction of the size, just because of how we're wired. And I found that, from my own biases, from my own personality, for many, many reasons, I found that I have a bias to play the markets from a long volatility side. I'm very comfortable that, with my views over the medium term. I have absolutely no idea what will happen in the next 24 hours. I don't pretend I will. So I'm adapting my game to be, to express my views so that I can survive them over the medium, longer term. And I have developed my views, where I have a long volatility bias. So I'm a big user of options. I like to control my risk, in the worst case scenario with option premium. Some people are very uncomfortable just paying premium because they feel that they're throwing money away. For me, it's the opposite. For me, just having a delta position and letting the market take you out in 24 hours, or having gap risk, or the market exploding in your face just because you were wrong or early or whatever. That's what keeps me awake. So I find that the emotional side is very powerful. It goes hand in hand with the views and what I look for. And I think that long option bias, is also part of my search. So I'm always looking for ways to achieve the cheapest optionality possible with the most upside possible. And the holy grail is if you can do that with positive carry. And those three ideas of how protecting your capital, having a symmetric upside and positive carry is really a big hurdle. But that's what I try to do, and that again comes from many things. But I do read lots of books. I like books that are in itself, and just to show you how obsessed I am with options. I do see books as options on themselves. You spend your $20, and many of them will expire worthless. But many books will be worth literally thousands of dollars, if not more. So I think that idea of exploring all across, different areas, different fields, but also with a purpose. So, for example, I was struggling a little bit at some point with the emotional side of the market, and I couldn't find good books on financial markets on dealing with this. And I actually went and looked for poker, and I found an amazing book on poker, the poker mindset, which I was reading through, and I line by line I could tell where he said fold, I said stop loss, where he said X, Y. So in that sense, I think it's very important to this process. I think it's more about finding yourself than finding people to tell you what to do. I think you need to find that own identity, and that means what am I good at, but also what is my own, mind. And what if it was a sports, and you are midget, it's probably not the greatest idea to be a basketball player, or the other way around. There are certain things where it's not impossible to be a star, and basketball being short. There are many cases, but certainly height is a factor. So I think emotionally, you can succeed and train yourself to pretty much do anything you want. But I think there are some strategies and some things that will be more natural than others. And in that sense, I've that search for me still continues, but is what has brought me to develop these multi-dimensional factors, including the way, not only the way I look at the markets and I look for the value and the asymmetry. It's all about the asymmetry. But I think there's an important point here, if I may, on asymmetry, because at the end of the day, there are potentially two extremes, right? Is people who are extremely good at what I would call an asymmetry of conviction, right? People that are really, really good at identifying, being correct. Okay, so they're correct 80% of the time. The problem, as we know, is what happens the other 20, right? And that other 20, it's almost like the better you are at calling the markets, the bigger the fall, because you're so not used to being wrong that when you are, you probably crash to death, right? Because you had it in a much bigger size, you doubled up, you kept the position a lot longer, and so in that sense, I've learned to survive. I've survived to learn. I live to tell. That conviction is very difficult to calibrate. I mean, how do you know? But the other side of the equation, which is the asymmetry of payout, that you can calibrate 100%. Okay, you can actually buy a digital option in the market that will pay you between 0 and 1, and you buy it for 5 cents. I'm long now stuff on China that is 100 to 1. Literally, I'm risking 1 cent and I will get paid 100. And that there's then what happens is the market is, you have those odds, and then you calibrate against your expected outcome, right? But then you do it from the basis of understanding your worst case scenario 100%. I mean, I knew if I buy these options, I know what's the worst thing that could happen, no matter what, right? There's no slippage, there's no gap risk, there's no liquidity, there's no provider. I know I bought something for 1 cent and it will pay me X or Y, 0 or 100. So in that sense, it's a long, winding answer, but there's really a lot of things that come to play. And I would say, in summary, that this is an ongoing search, and you realize, from mistakes or failures, that maybe your model was missing some pieces, and how to calibrate all of those. So, staying very humble and very open-minded, and trying to express the views in ways we with the right asymmetry of conviction and payout and positioning and others. I think is what works for me, And I encourage other people to find what works for them, not what works for me, because we're all different.
Yeah, I think that's just terrific advice. So many people want to, be the next Stan Druckenmiller or Peter Lynch or whoever, but it's really far more important to figure out what suits your own personality, because you'll never be able to be as good at being Warren Buffett as he is, and actually you probably run into all kinds of problems in trying to be him. But I think you're talking about this long.
Yes.
Go ahead. I'm sorry.
No, I was going to say that it becomes very obvious when you change subject. For example, if you play tennis, okay, you can try to be Roger Federer or Rafa Nadal or Djokovic or whoever, but it's very obvious that they have certain things, whether it's personality or physique or others, that you may not have, right? And I think to as much as you like the player, you need to adjust to something that fits you better, right? And in the markets, I think it's the same. Sorry.
Yeah, no, I mean, it's a great point. My son was a very highly competitive swimmer for a long period of time. And I remember, reading about Michael Phelps, and his torso is like 50% longer than the average torso. His knees hyperextend. He's got size 16 feet. His arms are too long. He's just got all these genetic gifts that other swimmers don't have. So yeah, that's a really good point. But I think you talking about this, being kind of long volatility versus short volatility leads into your next book. And also you mentioned something about the oil crash too, that I think is really relevant to the anti-bubbles, which is the new book that I'm talking about. And you said there was a misconception that OPEC really controlled the oil price. And George Soros has said behind every bubble there's a kind of a grain of truth to this, but it's usually based on a misconception like this. That's how prices get out of whack, is people believe something that's not true, or at least not completely true. And I think there's probably a similar misconception about central banks today, and the idea that they are all powerful in terms of propping up asset markets in order to create a wealth effect or build up the economy. Let's talk about maybe that idea and the bubbles versus the anti-bubbles. What are the anti-bubbles?
Sure. Well, I actually, like you, I draw on Soros for I guess the simplest, the definition of a bubble that I like the most is Soros. Yeah, he talks about prices that are artificially high, based on beliefs that happen to be misconceptions. And what I did, is I generalized the framework and said, fair enough, misconceptions distort reality, but they not only distort reality by creating artificially high valuations, they can also create artificially low valuations, right? So in that sense, the concept of anti-bubble, which I coined, has two dimensions, two meanings. First is the idea of anti-bubbles being, it's almost like the ultimate value investment. You're buying something that is artificially cheap based on a misconception. So it is a matter of when, not if, that will go up. The second powerful dimension of the anti-bubbles is the fact that by construction, bubbles and anti-bubbles are almost like distorted mirror images of each other. They're not symmetrical, but they are moving opposing directions. But what is important is that the moment that misconception is understood and the bubble bursts is the actual exact same instant when the anti-bubble reflates, because they're the exact same process, right? So in that sense, I called it anti-bubble, like an antivirus or an anti-missile, because I wanted to create this sense that it is a defense mechanism against the bubbles, right? And if you and there are many examples, and since I did this, very very interesting questions come up, right? It's almost like the idea does every bubble have its anti-bubble, right? And in other forms, and that's if you look at how the dynamics work, I think the 6th of February this year, we saw 2018 rather, we saw a very clear anti-bubble process between the S&P and the VIX, right? You had effectively the S&P pricing highly complacent valuations based on a perception of risk, which was not real. You had the VIX at whatever 9, I don't know what the low was, but 8, 9, 10 levels that were obviously, in my view, artificially cheap. And it was actually the move in the anti-bubble that triggered the move in the bubble, and not necessarily the other way around. And I think in that sense, this helps a lot as well, because when you look at other asset classes, some people might argue, gold didn't do anything in that process. It's what's wrong with gold and whatever. Well, you need to understand that some of these processes are sequential, interrelated, but at the end of the day, the synchronous moves between the bubble and the anti-bubble, it will trigger, and they do, domino and snowball effects. Domino meaning the first piece triggers the next one, and snowball meaning that the pieces are becoming bigger and bigger. But certainly this framework of bubble anti-bubble is hugely. It has been very, very helpful for me to put into perspective many of these things, but also understanding the timing and the sequence and the relative value across the process.
So, the bubbles in, well, I just want to actually pull a quote from the book, because I think it's, the book came out maybe a couple of years ago. Is that right?
Yeah, almost.
Okay.
I finished writing, about that time, yeah.
Oh, yeah. And so, last year in the markets, I think we were starting to finally see what you were discussing in the books in terms of, I think you write about one of the anti-bubbles is, correlation. Everything has been correlated. And the quote I just want to share is you write, the synchronous appreciation of all these markets creates a risk of synchronous depreciation, as and when the belief is proven to be a misconception, which the bubbles are built on, which creates a risk of false diversification as a portfolio composed of government bonds, high-grade credit, high-yield credit, emerging markets, and equities are just the exact same trade. And I think people just started to figure this out last year when essentially every asset class except for cash went down. I mean, it was one of the worst years for investors in history, because you saw so many different asset classes go down together. Is this kind of the anti-bubble of correlation kind of coming back? Do you feel that process is kind of unwinding now?
Yes, it is. But I think the most important anti-bubble, before we get into correlation, to me, the most important one and the trap is volatility. I believe volatility has been. Remember, when I wrote this, it was kind of science fiction, right? The idea for some people that there was this perception that central banks were in full control and that volatility will stay low forever. And these two misconceptions: the central bank put, but also the whatever it takes from the governments, the central banks and the governments. And the other big belief, which is what I call the complacent, desperate search for yield, which is the whatever it takes from the investors, right? These two processes together, these misconceptions, have created this series of parallel synchronous bubbles. Is in what I would summarize with another quote of the book, which is how we've moved from risk-free interest to interest-free risk. This idea of having portfolios and investors being literally bullied. We've been financially bullied to take more risk in every single dimension we can think of. So it's important to understand how those moves up, how that move up happened in parallel to understand why by construction it goes down together. It's not just something that happens to happen. It happens by construction. And those understanding those bubbles, everything starts, in my view, with government bonds and duration. You have cash at zero or negative. You have central banks buying literally almost infinite amount of government bonds you have this process that extends duration and forces benchmark investors and others to go longer and longer for lower. And faced with that crude reality and this perception that rates will stay down forever, there'll never be inflation, and oh my God, what do I do? It's almost like people were bullied and dragged into taking more risk, and that more risk has meant obviously credit. So if your treasuries were or European governments were very low, then Apple or others look great, and that goes obviously into not only into investment grade but MES and high yield and emerging markets. So you have this big carry trade. And that goes obviously into equities with put call parity between bonds and equities. It goes into liquidity. How I think every crisis has some big long-term crisis, and I think Ray Dalio puts it nicely in his new book. Has an element of shadow banking, right? That technology that lends a lot of money to the wrong people, the wrong size, the wrong price, blah blah blah. What I call the acronyms, and I think amongst many others, in this case we have private equity, private credit being that shadow banking, which is basically built on this belief, this misconception that who needs liquidity? There's plenty of liquidity, and I'm happy to capture that premium because the public markets were too rich. And so when you go do that, and on top of that, you basically monetize volatility through structured products and all sorts of direct and indirect ways in which volatility is being sold and monetized. You end up with this desperate search for yield and this complacency with the central bank put, driving all these parallel bubbles. Now, the phase one is volatility starts to normalize, and this normalizes naturally as a result of the long overdue normalization of monetary policy in the U.S., stronger dollar, higher rates, and that triggers that phase one, as I call it, is the move in the VIX in February. And what we've seen since, it's a gradual process of both implied and realized volatility going up, as I said earlier, through domino and snowball effects. And that move up in volatility, it's critical because I compare this to, driving a car at 200 miles an hour when the speedometer says 80. If you have an accident and you crash, what do you feel? And the answer is you feel the real speed you were running, right? In this case, 200, regardless of what the speedometer was saying. And in some sense, I would say that the volatility is the speedometer of the market. People have been the perception of low volatility of control meant that there was a perception that there was not a lot of risk, and therefore people were willing to take a lot more risk. Push the down on the pedal through leverage and speculative positions and size in ways that when the accident happens, you may not survive. So what we've seen, since that moment, has been a gradual, move up in volatility, which I said in my newsletter. I said, forget about the VIX at 9 or 10. We'll normalize eventually between 15 and 20, but we're gonna be in a process of higher volatility and spikes, just as pure averages, right? I think that is what it does is, as volatility goes up, it increases risk metrics such as VAR, value at risk, and all professional investors have actually been forced by the market to trade smaller. And that move up brings me to the second anti-bubble, which you were referring to, which is correlation. Now, the problem is that this perception of diversification, this perception of low risk through low volatility, and this perception that you were diversified because on a day-to-day basis, maybe you're Amazon and oil and whatever, and the Argentina bond were uncorrelated. That is noise. When things go wrong and correlations go to +1 or -1, and that's when, unfortunately, as volatility goes up and risk reduction starts, this forced liquidation starts to create and feed on itself through higher correlations. And the problem is that the combination of high volatility and high correlation means that your VAR explodes. Okay, in that sense, what it does is it creates, it feeds on itself. So all the wealth effect that you discussed earlier, all these positive, virtuous cycles on the way up become obviously vicious cycles that bring us into the next chapter around the corner, which is liquidity and reflexivity, which I think are going to be dominant in 2019.
Well, let's I think so. You mentioned volatility and correlation as being anti-bubbles, but let's talk about gold, because you also discuss gold as being an anti-bubble. I think one of the things that you read about, which is kind of interesting, in terms of, because people ask me, why should I own gold? And to me, the fact that most people think or have thought the last couple of years that there's really no reason to own gold makes me more kind of curious about it. You write in the book that the United States created more money in the 8 years of the Obama administration than all its previous history as a sovereign nation. And as a student of the school of no free lunch economics, as you call it, you worry about the current path and try to understand how and when the consequences of these excesses will manifest themselves. And to me, that makes me think about gold. So, what are your thoughts there? And the massive money printing essentially we've seen around the world and how it relates to gold being in an anti-bubble.
Well, I think it's critical. I think what we're seeing is, if we look at the patterns, what we've seen over the last few decades is we haven't really in some way solved problems. We've transformed them through the two simple miracles of printing your way out of a problem and borrowing your way out of a problem. In that sense, you can actually, it's very obvious that, for look at Venezuela or Argentina or Zimbabwe or Turkey, it's quite clear that if you abuse monetary and fiscal, if you try to print and borrow your way out of a problem, the degree of freedom in the system is the currency. So all those countries that basically believed wrongly that they could print and borrow fell into that trap that led them to more printing and more borrowing, and eventually, unfortunately, what goes is the currency, and it creates enormous problems. Now, that has been happening on a global scale across every single country in the world, and I think some are more have abused more, some have abused less, but we've seen this relentless process that has been pushing us into what I call testing the limits of monetary policy and testing the limits of fiscal. I started the book with negative interest rates, which to me was just one step too far. That was really the Fukushima moment that I discussed in the energy book. It was, my mind just was like, what is going on? And how does this end? And I think that process of monetary policy without limits, including not only printing money and QE, where left pocket lends the right pocket, the central bank lends the government, which takes us into negative interest rates, is one step too far. And I think, unfortunately, it hasn't really resolved problems. It has transformed them, and in my view, made them bigger through the bubbles. Now, as this time will tell, but where we're living today, the fact that volatility has been artificially low, correlations, and all the hidden leverage in the system, what it will mean for zombies and companies that have been kept artificially alive, for years, that should have been let go a long time ago. Sears and thousands of other companies all over the world. The impact that has in reflexivity through economic data and economic activity, employment, and others it's a very, very slippery slope that, in my view, will push central banks back into the only thing that they know what to do, which is printing more and borrowing more. And I think that that process will basically exacerbate one of the major problems that we've had all along, that we're not talking much about it directly, but it's currency wars. I'm European, and from our perspective, one of the constructive criticisms I would make of Ray Dalio and a lot of his fantastic work is this very US-centric or very domestic view of the world, where you look at how well things worked out for us using QE, and people don't realize that in that process, whilst the US was printing a lot and doing the right thing domestically, the people who were quote unquote the good citizens, such as Europe, saw the euro dollar appreciating towards 150, and along that we had obviously euro yuan, which with the yuan pegged to the dollar also going to huge levels. And what it meant is, surprise, surprise, 4 years later, Europe had a major crisis. Draghi walks in and realizes very well that, whilst many of these policies are sold as domestic, they have big implications in your neighbors. And he basically not only embraces all the unconventional monetary policy, he pushes it even further with negative interest rates. And he just wanted the euro dollar at 1. That's it. It's like, guys, I want euro dollar at 1. I want Europe to be competitive. I want to reverse this process. And I think that led to big issues with China, who was suddenly in the wrong side of the rooting for the wrong team. And we start to see problems in August 15, Jan 16, when China tries to change ship, and we saw what happened. And I think all these dynamics are still there, and they will come back in a big way, because if this crisis, if those problems weren't solved and they've actually been transformed and increased, and they materialize, we're now left with very little or much less ammunition. In the case of the Federal Reserve, still is earned a bit of room. Europe and Japan have virtually zero room. In fact, they have room, but it's room into further negative and helicopter money and other things that I do believe are coming. And as you see all this, there's a couple of major implications. One is, trade wars. I mean, at the end of the day, to me, along many other good reasons, for America first and Japan first and Spain first and whatever. But there's clearly, to me, a way where, if China devalued their currency by 20% in one day, which I think it will happen. But if and when this happens, or just this currency front, what the US cannot tolerate, or anybody could, is to say, listen, the fact that you devalued your currency by 20% artificially with all this printing and whatever, doesn't mean that I'm going to build my cars or do all my manufacturing there just because it's cheaper. So, I'm going to tariff you 20%. So you devalue by 20, I tariff you by 20. So I'm going to neutralize the impact. And so I see trade wars really as a mirror image of currency wars. I think they are a defense mechanism. And by construction, the unstoppable trend of more currency wars will lead to more trade wars, even if people like Europe initially is very reluctant, just like it was to unconventional monetary policy initially, only to fold later. So I think we might see a repeat where Europe naively, suffers the consequences and will come back later. But whatever happens in this path, which I think is very difficult to avoid, leads us to this process of, as Voltaire would say, paper money eventually converges to its intrinsic value, which is paper. And I do think that whilst, real assets in general and a beautiful house and a beautiful place will do very well in that environment. I think gold is very unique in the sense that it's the monetary asset. That's what makes a difference between gold and copper and oil or any other real asset or commodity. And I think gold is set to play a meaningful role. Gold is simply artificially cheap, in my view. And there are different models and ways in which you can look at it. But I try not to give just in the oil case. I remember when oil was at 120, and I would tell people it could go to 30 to 50. You lost all credibility. People thought you were a lunatic. I think, so a more moderate scenario of telling people, listen, I think it could fall to 70 was already, scaring people. My moderate scenario gold is 2,000 to 3,000 in the next, 2 to 3 years. But the risk is, in my view, skewed to much higher. So I do believe that gold will have a role to play. China, Russia probably agree, and I think this is an interesting chapter that is only just starting, but it will go hand in hand. I think you need to be patient. People who expect gold to do very well, when the S&P goes down, need to understand that gold as an anti-bubble. Okay, what is the bubble? And the bubble is paper currencies.
And so owning gold is something that I've written about the last couple of years too, and it's I think it makes sense. Dalio said everybody needs to have at least 5% of their portfolio in gold, but you don't just own gold outright, or even just buy it to hold it. Tell me about the Smart Gold Fund and what is really the goal behind that fund and the methodology behind it.
Sure. Well, this is the natural evolution of many years managing strategies, right? And the strategy has 4 building blocks. It has a core building block, which is a position in gold. Okay, this could be physical. It could be an ETF. It could be a future. I don't mind. I'm indifferent. But what it is not is gold equities. Okay, I think there's a misconception here in the market where lots of people see gold equities as just a call option on gold. Yes, it is, but they need to understand as well that call option has a knockout in the form of 3 main risks, which is taxation, expropriation, and nationalization. Okay, I've seen this movie already in oil, when oil went to 120, 140, and some of the companies were taxed 99% of the revenue, right? So let alone being a strategic asset being confiscated or being outright nationalized. And you could see Repsol, YPF in Argentina not long ago. So whilst I think the miners are, have their own merits and they could be great, and right now I even own some, this is a gold story. It's not a gold mining story. And there's nothing I hate more than being right and losing money. And that's just a word of caution. The building block number 2 basically recognizes that the fact that, you can be early, you could be wrong. And I think generally speaking, this concept of false diversification we discussed earlier has huge implications for asset allocation. Because if you build a portfolio with long onlys, right, even actively managed long onlys, right, you could see that the market, the S&P or gold or whatever, went down 70%. The manager lost you 50. They walk in the room and they think they're heroes, and the reality is, dude, you lost me 50%. Okay, yeah, the market is down 70, and unfortunately, what tends to happen is that many of these mandates lose 50 at the same time, right? So this is a game, and Warren Buffett talks about 2 rules of investing, right? Rule number 1, never lose money. Rule number 2, never forget rule number 1. Well, I am more popist than the Pope, as we say in Spanish, right? I think that what he means is, first of all, protect your capital, and second, compound on capital preservation. Those are the two rules of Buffett as I interpret them. So never lose money is protect your capital, and rule number 2 is compound on your protected capital. So in that sense, I find it a bit ironic and cynical, to be honest, that value can lose 70% when the objective was never to lose money, right? As it was the case in 2008. So in that sense, if the objective is never lose money, you need to be humble. And what I do is, first of all, I have some relative value in between the pieces. So the strategy is able to rotate between the core long in gold, which is, $100, 100 units. I can rotate subject to risk limits across other precious metals and miners. And I do that with strict risk limits so that it stays mainly being a gold play, but that is mean reverting alpha, which works very well over the long run. And that means today I'm 70% in gold, 30% in silver, which is my max long position. So I do believe silver is going to do quite well on a relative basis and absolute basis. But the key thing becomes those. So building block number 1 is my core long. Building block number 2 is my relative value. Building block number 3, basically, some people in building block number 4, both of them are insurance. Building block number 3 is the insurance to protect my capital. Okay, it recognizes the fact that I might be early, I might be wrong. So when I tell people, hey, I think gold is going to go to 3,000, but I'm buying insurance in case gold goes down. Some people scratch their head because they think I'm wasting money, I'm throwing money away. And the reality is I'm not. I see the insurance as a way to, especially when it's artificially cheap, as it is the case. I retain my blue sky or my upside, but if I'm early or I'm wrong, those puts will protect me. And what I do is I actually like to monetize those puts and use the money that I get from insurance to basically buy more gold. It is a very powerful accumulation process. There's lots of pluses from this insurance overlay, and overall it's been adding value, reducing volatility, and increasing risk-adjusted returns. This is something that we manage dynamically. And I use the example when you climb a mountain. What's your objective? If you speak to a Swiss guy who they know one or two things about climbing, they tell me my objective is making it back down the mountain. It's not going to the top. It's not going to the top first. They know that it's all about getting back down alive. I think here's the same. When the market is rallying, I'm very happy to use money to protect my capital, but also protect my gains. And when you fall, as you might, that rope is gonna protect you, and we use it to effectively accumulate the position. The fourth thing that I do is I take advantage not only of the volatility but also the correlation. This is insurance that is basically show me the money, and it is. I'm looking for gross mispricings in volatility and correlation, as I think it is the case today. But I have positions where I basically ask the market. I think, or I tell the market, I think, if there's a crisis, the dollar will do well, but I think gold will do better than the dollar. And believe it or not, the market thinks that's quite impossible. Mathematically, the fact that gold will do very well, and the dollar will also do well, is not something that the models would predict, because it's using the wrong correlations and the wrong stuff, in my view. So I look to buy insurance that is very cheap, over the medium long term, that allows me to monetize these things. So when you put together the four pieces, the core, the RV, the insurance, the downward insurance to protect my capital, and the upward insurance to show me the money and have leverage exposure, is very powerful. And that altogether is what we call smart gold. And that gave way to assist their strategy called Smart Treasuries, which does virtually the same thing for US Treasuries. And so we have a core long, we have relative value, we have insurance, and we have the tail upside. And those two strategies are combined into a strategy called Igneo. This is a daily liquidity usage and is now recently being onboarded through Prescient in the US. It's a mutual fund, daily liquidity. And this is a strategy that, in my view, is very well positioned to protect the portfolios by construction. It's up 9.9% in 2018 with very strong October and Decembers. And going back to the comment on false diversification, I find that if this was a soccer team, I'm Spanish, so sorry, I use lots of soccer analogies, but I find that most investor portfolios tend to have just 11 strikers. People build the portfolios, thinking, I want to make money. I want my equities, my credit, my high yield, my emerging markets, my private, whatever. Everybody's just trying to score goals, and that's not how you win. You may win a few matches. You may certainly not win the championship. And so in Spain, the only World Cup we ever won in soccer, the last 4 matches were 1-0, 1-0, 1-0, 1-0, and we saved the penalty in quarterfinals. So to be honest, to me, this is a game, where the goalkeeper and the defenders are hugely important. And cash is just like having a still keeper. If you throw the ball and it hits him, fine. But you need, what Igneo is trying to do is trying to be that goalkeeper that will, not only protect the capital, but also make money when the portfolio needs it. And I think that's really, what we're set out to do. I think there's a saying in the industry that goes like, you're as good as your last trade. I disagree. I think you're as good as your last crisis. And that's what we've set up to do. I mean, we're trying to, some of the dynamics that I explained earlier, the insurance piece, if you structure it the right way, is actually positive carry. So I'm doing things that, it is obviously taking a contrarian view about the market, but it's giving us, insurance that, will cost you very little or even make money while you wait. And I think these are things that are, when I explain it in detail, I always say the same thing. It's like an iPhone. Is it easy? Is it simple or complex? And to be honest, it's both. Okay, my 3-year-old nephew can use the iPhone and the iPad perfectly well. So it's a very simple instrument. It's a very simple strategy. This is what it's meant to do, and this is by construction how it will behave. Now, if you try to open the iPhone and do it yourself, there's a lot of technology there. And that's in a way what we try to do. We are the technology experts that basically build something that is very user-friendly, that a 2-3-year-old investor would understand, what it's meant to do under different scenarios. However, our engineering basically looks for these ways in which we do it the most efficient way. And I think, that the recent performance can show what can happen. And I think it's going to be an interesting 2019. I expect, it's going to be volatile and tricky, but I am concerned that the risks are skewed to the downside. I think gold could be a big winner this year, but I think the key is going to be around credit and particularly high yield and the zombies, which it's a problem with unprecedented size and risk. This is way bigger than we've ever encountered, and that means that the monetary and fiscal response will be potentially even equally large. And that unfortunately opens many other considerations and geopolitical and inequality and social, which are beyond our discussion. But as I say, and I finish the book, I hope I'm wrong. To be honest, I think I feel like a doctor telling a friend, dude, I think you have a big problem. These are your likely symptoms, and I really hope I'm wrong. But it's we've built something for a long period of time, and I think it'd be naive to think that it's just all over. Risks are skewed, but we'll see. It could take a while. It's going to be volatile. It's going to be tricky, but I am concerned that it could unfold into something bigger than most people expect.
Yeah, and I would encourage people to read through the book. There's so much in there that we couldn't even touch on the surface of. And I got to tell you, I love your analogies too. And I'm the quote that you're not as good as your last trade, you're as good as your last crisis is one that's going to just stick with me. I'm going to use that over and over again. But how can people keep up with you and your ideas and your thinking, Diego?
Well, reach out to me. I think some of you might be in Twitter. I'm Parrilla Diego with a double R and a double L. If you're qualified and investors, then you could subscribe to the newsletter. The strategies are. I'm working with the regulators to make them available for smaller sizes. Unfortunately, as of today, the minimum denomination is about $125,000, which means that a lot of people are left out because they probably don't want to put everything in there. But certainly, very, as you can see, I'm very open-minded to very transparent in the way I'm thinking. Welcome the criticism, and I think in that sense I'm not super active on the media and stuff, but I do welcome referrals and having smart dialogue and debate. So in that sense, probably the easiest to reach out through Twitter, and then we can establish dialogue. I'm based in Madrid, but I do travel extensively. Throughout different parts of the world, and I'll happen to be in Miami for the hedge fund conference at the end of the month. So some professional investors might listen to this, might be there. But otherwise, feel free to reach out, and I'm sure we'll find the most efficient way to stay in touch and keep you posted with the thinking.
Terrific. Diego, I'm so grateful to you for taking the time to do this. The insights are just so valuable. I know everyone's going to just be very appreciative of you sharing your wisdom with us.
My pleasure. And I must say, I really enjoy your own contributions. So next time I should interview you. But thank you as well, and all the listeners. I hope you find it helpful, and I look forward to staying out of trouble and hopefully taking advantage of all the opportunities ahead of us.
Absolutely. And speaking of travel, I'm going to have to make it out there to Spain, and we'll do this in person next time.
There are worse places than Madrid, trust me. Place. You're all welcome to come.
Terrific. Thanks a lot.
Thank you, Jesse. Thank you, everybody.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.